Welcome to the ValueHunt podcast, and today we have an extraordinary guest joining us, Diego Milano, a one-of-a-kind investor based in the heart of Alentejo in Portugal. Now you might notice our setup is a bit different today. Diego's coming to us from a charming town of just 5,000 people, where the internet hasn't quite caught up with the times. But don't let that fool you, this is exactly what makes Diego's perspective so valuable. While we may not have video and the audio may have its quirks, what we do have is an unfiltered, off-the-grind investment expert. Diego's insights came straight from a place untouched by the usual market noise and big cities biases. So let's dive in and discover how sometimes being disconnected can lead to the most connected investment insights. Welcome to the ValueHunt podcast, and today I'm so excited to be here with Diego. He's a fund manager, a Brazilian fund manager based in Portugal, and he has such a unique strategy that I really want to dive deep into it and see what we have to learn from him and his experience, which is huge. And so, Diego, why don't you say a couple of words before we jump right into the first question?
Yes, of course. Thank you for having me. Well, let's start from college, which is usually how most people start talking about their careers. I actually graduated in aeronautics engineer in Brazil. So my first few years of professional experience was actually in the field of engineering and not in finance at all. But after a couple of years, a few friends of mine who were already working in the financial industry convinced me that it was much better to go to this field. I like the challenge. I like the idea. So I went to work for, it was actually a value fund. It was all equities, but that was in 2007, a little bit before the financial crisis. So since it was a leverage fund, you can imagine what happened during the crisis.
Yeah.
So yeah, after a couple of years there, I went to work to the proprietary desk at Itaú, which is the largest bank in Brazil. And again, it was all a focus on equities. But the proprietary desk, they usually trade and have positions in all kinds of different strategies and instruments across the world. So I was responsible for looking more long-term to equities, which at some point it became quite a challenge there because, people that are taking positions in FX and in interest rates and so on, they usually have a much shorter time frame in terms of the results that they are expecting. And they also had a lot of flow information from clients, which in the equities, you don't have it. The flow information was all in the at the brokerage side of the business, which due to the Chinese wall, we didn't have any information at all. So after a few years there, actually, I spent 7 or 8 years there. At some point, I got fed up with Faria Lima, which is kind of the Wall Street of Brazil, fed up with the bank, fed up with São Paulo, fed up with Brazil, and decided to move to Europe and just at first manage my own money the way that I like best, which is in a deep value perspective globally without any kind of constraints in terms of geography or size of the companies or anything like that. And then after a few years, two of my brothers asked me, hey, why don't you manage part of our money exactly the same way that you do with yours? I said, okay, fine. That's no problem at all. It wouldn't add any more effort on my part. A year later, a few friends of mine asked me the same thing. And then I was thinking, maybe I should do it a little bit more professionally. So I launched the fund with the same fee structure that Warren Buffett used to have in the 50s and 60s in their partnership, which is charging zero management fee and 25% of the returns above a threshold of 6% a year, which is the only way that I feel comfortable managing my family and my friends' money, because I will only get paid if I have a good performance, and I will not be paid just to manage some sort of money regardless of the results. So
Right.
that's pretty much it.
That's pretty interesting. Actually, you answered a couple of questions I had, and I didn't even send you the questions, so I'm wondering whether you hacked me or something. But
No, I didn't. It'll all be a surprise here.
but good. It's good hunting ground for the next questions, and I actually want to go on some different tangents. The first one is your engineering background, because I will soon enter university, actually October. So, and I picked an engineering degree because various reasons I won't explain here because it would be too boring. But I was wondering what was how the engineering degree helped you in investing, and if it helped you in any way, because maybe it was just lost time and you then pivoted to finance, but maybe it also helped you in getting some useful mental models or something like that. So why don't you guide us through how you think about that?
Yeah, sure. Well, first of all, congratulations. And I hope you like engineering, and good luck with that. uh, well, actually, I would say not only in Brazil, but in most places outside of the US and maybe some parts of Europe as well, it's pretty common actually to have engineering students entering the financial business, mainly because of the analytical skills that you learn and you learn to develop while you're in an engineering study. Uh, I decided for engineer when I was your age. I had no idea what field of business I would like to work in. Uh, the two oldest, but I have three older brothers, and we were always in a competitive family. So my oldest brother entered
Okay.
into a law school in Brazil, which was a private law school, and usually in Brazil, the public universities are better than the private ones, taking away very
Right.
specific examples, but that was what 20 or 30 years ago. So my oldest brother went to law school in a private school. The second oldest went to law school at a public school, and the third one went into medicine in the public school. So I was thinking, well, what can I do to be better than them? So I decided to go to engineering in that specific school, which is called Aeronautics Technological Institute in Brazil, which it's usually among the top two or three colleges in Brazil. I had no idea if I wanted to do engineering or not. I was actually thinking about medicine at the same day that I was applying for college. But anyway, I was
Wow.
there just for the challenge. And
It turned out all right.
it turned out all right. Yeah, exactly. To graduate in it was really a challenge. But again, what I wouldn't say it was a lost time at all. Mostly because I'd say the skill that I learned the best there was how to think analytical and rationally about things, about anything.
Right. That's everything. That's the main reason why I'm going into engineering, and also because I hear that a lot of people say that their finance or management degree was useless in real investing, and so Yeah, I guess I'll keep learning that by myself, and then also get the skills from engineering that you are mentioning. But go on. Sorry for interrupting.
Yeah, and you never know when you will be able to apply the things that you learn. For example, there are a lot of good friends of mine from college that went to the financial sector, but they are mostly focused on the technical side of the business. I mean, trading
Okay.
options and arbitrage of very complex instruments sometimes, which due to their math skills, it came easier for them. It's not my case, but they could apply this kind of business of programming, etc., in the financial business. So you never know.
Yeah, yeah. I guess it's all preventive work and not really trying to apply that. It's good to have some theory and basis for doing other stuff. Yeah, but anyways, thank you for commenting on your experience on
Sure.
that side. It's really helpful from a personal perspective, but I hope also to other people. And then I would like to ask you more about your fund because in Portugal there are not so many value investing funds. I know a couple of them, but for sure you're one of the only funds actually applying a true value investing strategy. Some of them might market themselves as value investing, but it's a totally different thing. So I would like to know how hard and what's the best part and worst part about managing a fund, specifically in Portugal, for anyone watching that wants to launch a fund in Portugal. And yeah, that would be pretty useful. And it's something that always interested me, the actual technical part of launching a fund, because I find that not so many people talk about that. So why don't you guide us through that?
Uh, okay, I'll try to do that. It's not very particular to Portugal because
Mhm.
the way that I structure the fund, it could be structured anywhere in the world. I have at the moment something like 10 clients and that's it. Okay, it's scalable. I wouldn't have no issue with having 1,000 clients, but at the moment it's like 10. None of them are European actually. So I am based in Portugal. I live in Portugal, but I could be living in, I don't know, the Caribbean islands or anything like that, or Australia
Okay.
or whatever. In that sense, it doesn't make any difference where the fund is structured because at the end of the day, it's not structured in Portugal. It's an offshore fund.
Okay.
That makes much easier and much cheaper in terms of compliance issues. I cannot, for example, actively market the fund in the European Union. If I were to do that, I would have to be licensed here, and it would be much more expensive in terms of personnel, in terms of taxes and everything. So if I were to do that, the fund should be much larger, and it's not. So
Right.
maybe a few years from now I'll do that, but that's not the case right now.
So now that you talked about a bit about your fund, why don't you explain to us your actual philosophy and how you think about deploying the capital of your clients and your own capital for that matter?
Sure. Um, well, I'd say this: the main thing that I would like to explain first is that the price of anything, any security, you can see at your screen, and everybody knows what it is. Okay, the value is necessarily dependent on future. I mean, if we're talking about the price of the stock, you would have to think about the price of the whole company, which is the discounted cash flows from now until the end of the day. It's discounted by some by some by some rate. Uh, Due to that, we're talking about future prospects. Necessarily, you don't have how to. You don't. There's no escape from it. since we're talking about future, that is inherently doubtful. We don't know what will happen or not. We can have a pretty good bet in terms of, I don't know, regulated revenues and fixed expenses and so on. But we still have a future in front of us that has a lot of uncertainties. I mean, COVID, I mean, the assassination attempt on a president and anything like that. So it changes the value of the company every single day, which we don't know for sure what will happen. Especially during the 70s and even the end of the 60s, there was a famous theory of the markets that said that markets are efficient. When they say that markets is efficient, is that all the available information is priced within the stocks. Therefore, there is no way of beating the market by knowing more than what's already available. So you shouldn't even try. And that was kind of debatable for a time because, well, you're going to engineer, so you see that when we're talking about physical disciplines like mathematics, engineering, physics, and so on. Okay, you can analytically explain things like that, and it makes sense. Whenever you have the human behavior embedded in these structures, they become too complex to just automatize, and at the end of the day, it doesn't work like that. For example, one of the largest position of the fund right now has 2 times its market cap in cash. Can you hear me? I think the image is stalled. David? Are you hear me?
Yeah, it's like a bit laggy, but yeah, I can hear.
Okay, good. So you can see very clearly, especially when we are talking about small caps or different geographies, the market is not that efficient at all because there is some clear value within the companies that are not priced as it should. Or even large caps in the US, we should be as efficient as possible in terms of pricing the information that's available. The stock prices vary like 30, 50, 100% in a single year. So there's human behavior involved, and therefore there's no complete efficiency in the markets. What I try to do in the fund with my own money and with the client's money is to find the specific opportunities where the gap between the price that is in the screen and the value that I believe conservatively appraised can be said of the company is way high, is ridiculously underpriced. That's where I try to invest all the fund. I know that I don't look at the market as a whole because of that. I look at specific opportunities. I look at the exceptions at the end of the day. So because of that, I don't really think I have a benchmark, and I actually don't see volatility as any real measure of risk, because sometimes it's very thinly traded securities, which spend like months sometimes with no trade at all, and then all of a sudden I can grab a big piece of the company because of that, or the price goes like 50% in a single day because there was some buyer, that kind of stuff. So it's a concentrated fund. We're talking usually between 5 and 15 positions only. It's weird companies, weird positions.
Yeah.
Yeah, that's it.
You remind me slightly. Don't get too high on your own supply, but you remind me a bit of Nicholas Sleep and Zach
Oh, okay.
from the Nomad Fund, uh, because they were kind of buying like these Zimbabwean companies, cement businesses in Vietnam or something like that. I don't remember the country exactly, or yeah, Bangladesh,
Yeah,
whatever. So
Zimbabwe for sure. Yeah.
yeah. But you also like to hunt in these, let's say, less liked geographies by some for some reason, and obviously that may present opportunities, but also risks because at the end of the day, you're not really there in the day to day life, so you can miss on some information or really just have those unknowns that you don't know.
Mhm.
So how do you, let's say, think about that, and how do you sleep comfortably at night knowing that you have a lot of positions in these, let's say, more extreme countries, or more less safe in terms of corporate governance and corruption and stuff like that? Because I presented some of your ideas to my mentors, and they immediately say, "Oh, China, it's corrupted and stuff like that." So, explain to us why most people are wrong in not looking at in those countries, or how do you think differently about that?
I don't think they're either right or wrong. It's just the approach that they have. I think I
Okay,
know that by doing that, they miss a lot of opportunities. Just as when
right.
I said that when I try to find securities that are extremely undervalued, I miss a lot of opportunities too. Okay, it's just a different approach, a different game that people are playing. It's not. I don't think it's a term. It's a right or wrong thing at all. Uh, but I think that when you look too broadly into China is uninvestable, or emerging markets are risky, or corporate governance is an issue with this particular geography, you kind of miss that it happens everywhere. It just happens in a different way. Uh, for example, you probably remember Wirecard in Germany. Uh, it used to be as maybe what 3 years ago, something like that. When we think too broadly about China is uninvestable, or emerging markets are risky, or corporate governance is an issue with this particular kind of geography for some reason, or uh, corruption is an issue, you kind of lose the the truth behind it, that some kind of money being taken away from minority shareholders happen all the time everywhere in the world. I mean, before Larry Culp, the last CEO of GE had two private jets for him. That's money that should be in the minority shareholders' hand. I mean, in the shareholders as a whole, because it was a corporation, that it was just taken away by management. Uh, you probably remember Wirecard in Germany, which went bust maybe 3 years ago. It was a DAX company. It was the main fintech of Europe. And I mean, it's Germany. You cannot really complain about corporate governance in the EU. And the company was a complete fraud. Even the regulator in Germany was kind of protecting the company unknowingly, probably, but they still were. There's a very good book about it, wrote by the Financial Times journalist who discovered the fraud, and the regulators in Germany went after the journalist, not the company. So it
Wow.
happens. It happens all the time. I mean, construction business. They usually, I wouldn't say usually, but there are plenty of cases where the controlling shareholder of a construction business sell land to the construction business at inflated prices, or the controlling shareholder of a concession business has a construction business that makes all the maintenance of the roads and so on. So there are ways to grab the minority shareholders' money everywhere all the time. Of course, when we talk about corruption in, I don't know, mine concession in Africa, that should happen more occasionally. But once you realize that it can happen everywhere. I mean, my companies that are based in Hong Kong, I'm sure they don't have a Chicago in a Picasso in the wall of their headquarters, which some companies in the US have. That's money that shouldn't be there. You have to look at the past. You have to, the way I do at least, is I tend to think that a part of the value will be taken away from me and will be given to usually controlling shareholders, but also management. As long as the past of the company is not too enmeshed in this kind of behavior, I'm good with it. I just taking in my head, for example, a 20% discount of the fair value that I think the company is worth, and that's it. So in that case, I can invest in China, I can invest in the Philippines, I have positions indirectly in Africa. In Latin America, it happens all the time. I mean, the start of my career was in Brazil, so I saw that. And it still happened. It's a very, very well-regarded company in Brazil, actually. It's a packaging company. They make cardboards. And since the name of the company is named after the surname of the controlling shareholders, the founders like 50 or 70 years ago, they charge royalty rights for using the name of the surname of the founders. It's a cardboard. You don't really have a brand or anything like that. Anyway, it's small, so people don't complain a lot, but it happens.
Yeah, that's really interesting, actually. And I was wondering how your process of building conviction works, because maybe if you travel there and visit the headquarters and stuff, you might get a bit more comfortable. So I was wondering whether you do that often, or do you talk with management, or you just stay on the public sphere and try to get as much public information available there is and make a judgment based on that?
That's a very good question. When I was working in Brazil, both as a research analyst and a portfolio management, I used to visit a lot of companies, a lot of managements. I probably got in touch at the time with maybe 70% of all listed companies in Brazil, some way or another.
Right.
Usually, the people that talk to you, the IR guy, the CFO, and the CEO are very good at selling you stuff. I mean, they are people's person. They are not necessarily analytical person. The people, and they don't tell you all the truth. The bad things you have to discover by yourself.
Okay.
Nowadays it's much easier because you can find information in the internet about the founders, about employees that left because of some specific reason. So at some point in my career, I decided that I didn't want to go visit management as a broad way of looking at companies. If I have some specific issues, specific questions that I need to ask them, I do. Not necessarily in real presence, sometimes only email, but I do. Sometimes the companies don't even answer it. especially when the company is too small and has a majority shareholder. They don't really care about what you're asking, but they usually do, and sometimes they don't know the answer. Sometimes people there, you realize that you know more about the company than they do. I don't mean the CEO or CFO, nothing like that, but the people that are answering your questions. And they just kind of evade these questions. So in terms of my
Right.
process, I don't usually go after the companies, only after I have some specific issues, and that usually happens after months of researching the company or even investing in it.
That's interesting. So, as a rule of thumb, you don't really talk with management.
No.
Yeah, that's pretty interesting. And could you guide us through how your general approach and process looks like, from finding a business, where you find it, where you find the idea, to actually doing the research, and how much time you invest in doing the deep research? Which fonts do you use, like talking with farmers or customers and stuff like that? And yeah, maybe your general approach would be useful for the viewers and myself.
Yeah, I'm okay. I don't have a specific program in terms of how do I do that. It sometimes happen by screening. Sometimes happen because I'm researching a specific company or a specific sector that when I'm doing that, I'm looking at their peers and a lot of different companies, and I just stumble in another opportunity. Sometimes it's a company that had some issues in the past. It can even be the stock price that was too high a few years ago, and all of a sudden it became an opportunity. So it's like when Peter Lynch says that the guy who turned the most rocks wins because they will find the opportunities. I tend to look at a
Right.
lot of rocks. I did go from A to Z, well, like they say, in a few stock exchanges. Again, nowadays it's much easier. You don't have to have a physical manual and do that page by page. You can
Yeah.
just say, "Oh, I don't want to look at telecom business. I don't want to look at I don't know biopharma or anything like that. I just skip that and then look through to from A to Z." I usually, when I look at what a company does and the main numbers of the company, I am able to disregard the company in 30 seconds, a minute. I know that by doing that, I'm missing a lot of opportunities, but the ones that I decided to investigate deeper, uh, I know that they may be a good price for a reason. And then when I look more in depth into a company, sometimes it can happen in a day. Sometimes it takes weeks to build the conviction that okay, maybe it's good to have a small position in the company, and it only becomes a large position after months or even years. But the largest positions in the funds
Interesting.
are at the moment more than 20% of the funds, so they are pretty big.
That's really, really interesting. And one thing that obviously is important to understand as an investor are biases and cognitive biases. And there's one that's really tricky for me, which is anchoring.
Mm-hmm.
So you basically find out about a business at a given price, say 80, and then once you build enough conviction and yeah, to build it into a big position, it's already 160 or something like that. So how do you think about that, and what's your general approach to fighting this specific bias? Because if it takes years to build it into a big position, you're not going to get the same price. Even it can be lower or higher. So how do you deal with that?
Yeah, I'm not immune to that at all. uh, I would say that when the price goes much higher, I have a problem buying it. Okay. One of the, not one of the uh, worst lost opportunity in my career was a company that in Indonesia, which is the controlling shareholder of a petrochemical company there. And it was straight,
Right.
that was, I don't know, 2012, maybe 2013, something like that. Let's say it was starting at 50. Okay. Uh, I looked at it and I thought, oh, come on, this is worth at least 200. The
Hmm.
stock price went to 50 to 60, 70, 80. I didn't buy at all. I was just I still studied the company because I had never looked at Indonesia. I knew petrochemical companies, but it's a different country. There's different contracts. I don't know the founder. Things like that. It takes time to be comfortable with. Uh, then I look at it a little better. Oh, maybe it's worth 300. The stock was already 100 and 100, 120, stuff like that. And I said, you know what? Forget it. I'm not gonna pursue that. And the stock price maybe went to 1,000 after that.
Wow. Wow.
It was really like that. So, uh, did I learn something from that? Well, I learned that who I am. But I still struggle with it. Uh, when the stock price goes up by a lot in
Yeah.
the first few months that I have a small position, I'm usually not able to build a big position. It's only when the company is delivering it and the price doesn't change or even goes a bit lower through time that I increase the position and make it really big. But it happens both ways actually,
Interesting.
because sometimes something happens that the value of the company also you have to trim, and instead of saying that it's worth 100, you have to realize that it was actually worth just 80 or 60 or something like that. And by that time the price may get lower as well, and that's harder actually than
Right.
to buy more when the price is going up, because you used to think that the stock is worth 100 and it's actually worth 80. So, oh, maybe it's still cheap enough. Maybe I should buy more. And at the end of the day, you're just fooling yourself.
Hmm. Yeah, for sure. I have the same kind of issue that you have, so it's easier for me to add when it goes lower. It happened many times with my positions, but I also increased sometimes when it went higher. But
It's
it
harder.
just feels better.
Yeah,
Yeah, it's harder. It's harder. But yeah, investing is all about being rational. So if the capital allocation rationale makes sense, supposedly, if you have a good return, it doesn't matter if you buy at 60 or a multiple of 60. So,
but it's also I would
um,
say that it's also a matter of knowing yourself. Uh, if you
yeah,
know that you
exactly.
have this bias, you can even either struggle to improve it, or you just realize and then well, don't touch it. I won't lose my nerves because of that.
Right. Since I'm still 18, I'll try to lose my nerves a couple of more years to see if I can change my
Of
biases.
course.
And once I reach, let's say, a mature age, I'll just accept what I have and play with that. But for now, I'll try to reduce the biases to to a minimum
Definitely.
if
Yeah.
possible. But it's always hard. I'm not saying I'm going to make it, but I'm trying to learn. Let's say. So yeah, that's really interesting. And you touched upon a mistake of omission that you committed. You saw the price was much lower than the intrinsic value, and you still didn't act on it. So without losing too much of your, let's say, pride in your investments and stuff like that, could you share to us some of your previous mistakes and what you learned from those?
Sure. Do you want omission mistakes or commission mistakes?
Your most brutal mistakes, be it
No,
omission or commission.
the most brutal one was this one. It doesn't show up in
Yeah.
any numbers because it was an omission mistake, but I lost maybe 5 or 10 times the upside that the stock had.
Yeah.
But in terms of commission, last year I had a couple of positions that went to zero. They weren't that large compared to the size of the fund because I knew from the beginning that they were riskier than usual, so it could happen.
Right.
One of them was actually a warrant. It was not the stock. It has all the pitfalls that your mentors were saying about emerging markets and different structures and the behavior of the controlling shareholders and stuff like that. Because it was a warrant over a contract that was signed between a SPAC. A SPAC is the Special Purpose Acquisition Vehicle, which tends to be full of pitfalls always. But it was to a casino in the Philippines owned by a company in Japan, in where the controlling shareholders were fighting among themselves. It was a mess. And at the end of the day, the son of the founder, they were both fighting, the son and the father, just ripped the contract of selling a stake in the Philippines casino to the SPAC. So since the SPAC doesn't have the asset anymore, the warrant went to zero.
Okay.
The SPAC sponsor went fighting courts to say, hey, they can't do that. We're in the US. The contract was signed in the US. He was right in that sense. But I think that was when I committed my worst mistake, because I was fine with the controlling shareholders fighting. I knew this company from years ago, from more than a decade ago. I was fine of having a warrant and having a SPAC because I knew the underlying asset, which was really good. It was the best casino of the Philippines. To give you a sense of the size of it, it was maybe twice the size of Bellagio in Las Vegas. It was huge.
Wow.
Yeah. And the problem is, once you go to the courts to fight over an asset in the Philippines, anything can happen. I'm not an expert in law or anything like that. At that moment, I would have lost maybe 20% of the money. I should just get out. And I decided no, because if he wants in courts, that has 200-300% upside. Well, what are the odds of him owning in the courts? I have no idea. That is the point. I had no idea. It could be 1%, it could be 90%. I didn't know. I should get out. I was out of my league there. It was out of my circle of competence. So that was one mistake. The other one was a gas company in the North Sea that was just about to start producing. So they already had the explored phase. Most of the infrastructure was in place. They had Berkshire Hathaway Energy as partners in the field, not in the company itself, but in the field. So I said, okay, if Berkshire thinks it's a good asset, I think it is. And you don't have the exploration risk anymore. It's just producing. Well, they start producing, and after months, they said, well, the flow of the gas is not as we were expecting, and it's not economical anymore, and so the company went busted.
Wow.
What was my mistake there? What do I know about gas producing? I don't know anything about that.
Yeah.
If
Yeah,
it
yeah,
were already producing and we're just looking at the decay of the field, that was one thing. But the risks of starting producing, I didn't know it at all. I shouldn't even be looking at it.
interesting.
So
Yeah, for sure.
I'd say that
I
most of
also.
my commission mistakes were either because they were completely out of my circle of companies at some point, or because of anchoring, as you said, that things changed and I didn't recognize it in time.
That's interesting. Yeah, same for me. Same for me. So I also invested in an oil company. Fortunately, it was one of my best investments, but still a mistake because I didn't understand and I just relied on someone else's conviction. And when things changed, they sold an asset, and I couldn't really understand what the change in intrinsic value was, and therefore, yeah, it was a mistake. But fortunately, I didn't lose money.
Oh,
It didn't go to
these are the
zero.
good
It actually,
mistakes. You
yeah, yeah.
learn and you earn money.
Yeah, yeah, exactly. So it was pretty interesting. Actually, the guy that gave me the idea, or yeah, that I found the idea from, was the last person I interviewed in this channel. So if you're curious, go watch it. But it's an interesting case, and fortunately, I hope to make more of these mistakes where I learn and make money.
Good, that's
So
good. Well, what is the name of the company?
yeah. Unit Corporation,
Okay.
back in Tulsa, Oklahoma, in the U.S. So basically, they emerged from bankruptcy. This made the price be much lower than the intrinsic value, and the company was trading at like 30 at the time I bought, and it was worth around 100. And the management started buying back a bunch of shares and paying dividends, special dividends. Uh, at some point, they paid $20 per share dividend, and that's when they sold the asset and they actually distributed the cash. But obviously, when you pay $20 per share in dividend, and it's because of a sale of an asset, the intrinsic value actually changes,
Hmm.
because yeah, you're not only giving out the cash, but you're also selling a producing asset. So over time, that asset would generate cash flows and stuff. So yeah, but at that point, the stock price went to 60 or something, and then when they paid the dividend out, it dropped to 30 or 40 again. So at that point, I said, "Wow, it's much cheaper now," and then I bought more. Fortunately, the price hasn't moved since then, so I didn't lose that extra risk I put into that position. But and I also gained more dividends over time because I had more shares. But still, it was a mistake because of what you said. I didn't really base my judgment in the facts, but just in the market movement. And you generally hear the good investors say, "Oh, when it drops, you have to buy more." Because it gets cheaper, but it's not always the case, and you really have to learn for yourself if it's getting cheaper or it's just adapting to a new intrinsic value. So yeah, that was the lesson there. Fortunately, still one of my best investments. But anyways, we're here to talk about you and not about my own investments. So let's move on to the next question, which is about measuring yourself and let's say the accuracy of your bets. Because since you are long-term focused, such as me, such as I am, it's hard to get a good feedback because the feedback loop is really big, and therefore the indexes might move and your positions might not, and there's a mismatch in the movements of your positions and other benchmarks. Therefore, you can't really measure yourself using other benchmarks. And I'm wondering, how do you keep your consistency in your process and strategy while you're underperforming basically every index, which it was the case until last quarter's letter, but now you're outperforming since inception. And so how do you deal with that feedback loop problem and dealing with the clients and you're underperforming. So how do you keep the consistency in those situations?
That's a really great question. First of all, I wouldn't say that I was underperforming all indexes until the last letter. I was underperforming S&P for sure.
Yeah.
But
Yeah.
when I look throughout the world, I was not that bad. But in any case, any investor in the fund could have actually just bought the S&P and be much better than I was until a few months ago.
Right.
There are two underlying questions here actually. First of all, how do I deal with clients when I am underperforming? And that's the easier question actually, because you have to have clients that understand how you invest, understand what the investments are at the end of the day, why they are cheap, and they have to believe in your philosophy and your strategy. If I had a bunch of investors that were there just because of past performance, they would all withdraw at the worst moment. And the second question, which is much harder to answer, is how do I compare myself? How do I control my emotions when that happens? And the way that I do that is looking again and again and again at what are the intrinsic values of the investments that I have. Trying to be as honest as possible, intellectually, psychologically, to myself. And that's a struggle. That's something that I had to do every single day. Because some companies were very simple to look at it and say, whoa, this is really, really, really cheap. And others were, well, something has to happen so it can unlock value, which is usually the case when the gap is so extreme, right? So you probably read about the Portuguese company that I had.
That's
sorry?
No, I'm sorry. I was getting a bit. I couldn't listen to you well, so I interrupted. But yeah, go on. I'm listening.
Okay, no, I can go back a bit. Maybe it's better because that's.
No, you can continue because the recording will keep going from where it was. It doesn't lag on the recording. It's just me.
Okay, good. So you may have read about that Portuguese company that I had in the portfolio that it didn't trade at all. I at some point had more than 1% of the company, and my fund it's very, very small. So for months in a row there was no trade. And then once in a while, I was able to grab a bunch of shares and increase my position because it was very clear that the company that at the time it was priced at, let's say, 30 million market cap was worth more than 120 million due to an indirect position in the controlling company of Semapa, which is a controlling shareholder of Navigator. Yeah. The problem is, especially when markets were going up, the stock didn't do anything. It was just standing still there with no trade and no volatility, so it doesn't really matter. But because of that, I was, especially in this particular position, I was underperforming for a long, long time. And then they sold the position at a huge discount to the intrinsic value. In that sense, they did grab the money out of minority shareholders because the majority shareholder was the same of the company. That's part of the business. I knew that could happen, but it still went up like, I don't know, 100%. A little bit more maybe. in a single week because of that. That was
Right.
the value being unlocked due to a specific event that took years to happen, but they could very well happen in 1 year, in 6 months, or in 10 years. I didn't know. I just knew that the value was there, and I kept looking at it and analyzing if the value is really there or not. That's all I could do. Uh,
That's really, really interesting.
Monish Pabrai talks about the only spreadsheet that he has, which is of the intrinsic values of the companies that he has when they are really struggling and underperforming. He keeps looking at it to have a lifeline to see that, hey, I'm not that stupid. I just need to wait a bit more.
Yeah, yeah, that's a useful spreadsheet to keep on. And I'm curious. This is a small question. I'm curious to know whether you think more in terms of intrinsic value, so the gap between the current price and the intrinsic value, or in terms of calculating your expected internal rate of return over time. Because I've come to become more and more comfortable with actually investing in businesses that increase their stock price because of their increase in fundamentals. So it's more of it's not like you mentioned a catalyst that unlocked the value all of a sudden in 1 week. It's more of a gradual thing. Just because I feel like I can analyze that better and it's more predictable,
Mhm.
generally speaking. Obviously, you can have a business that's consistently growing at 10% over 10 years and then all of a sudden it shrinks, but as a rule of thumb it's easier to analyze that when the fundamentals are consistent. I was wondering whether you think more in terms of the intrinsic value or actually the internal rate of return that you can get, say, in 5-10 years.
They should be the same, actually, right? Because when you look at the intrinsic value of an asset, again, you're discounting all the cash flows in the future. And you have to consider that in year two, the cash flows will be 10% higher. In year three, it will be 10% higher, so on and so forth. So it should be the same. And we would be talking here about surprises in the results that are being delivered by the company compared to what you were considering in your appraisal of the intrinsic value. Uh,
Right.
but we always try to be more conservative due to the margin of safety, right? So in that sense, I understand what you're saying. I usually try to think about intrinsic value, being conservative on the assumptions that may lead to the intrinsic value being higher through time, and I'd say that I accept a lower gap between the price and the intrinsic value that I conservatively appraise for those companies that you were mentioning that grow consistently. So, for example,
Right.
one of my positions is in a bank in Kazakhstan,
Okay.
which is one of the largest ROE banks in the world. It is
Wow.
they had more than 30% ROE, and that's not because of leverage. That's not because of interest margin. That's not because of the cost of risk. That's because of operating expenses, actually. When you look at all the
Okay.
other variables, they are comparable to leading banks in other emerging markets, in Brazil, in Peru, or whatever. Um, so this guy, in theory, were it able to reinvest all the earnings that they have in a single year, they should be able to go 30% a year, right? But they're not able to do that. So they deliver 50% in dividends, and they're still being able to grow 15% a year if nothing happens. Um,
Mm-hmm.
it trades at less than 3 times earnings. So, well, it's a bank in Kazakhstan. Maybe they could sell it for 6 times earnings, 9 times earnings. That's it. That's the intrinsic value for now that I conservatively appraise. But I know that their value is growing at 15% a year. So even if I had comparable opportunities that just looking at the spreadsheet can have a higher upside, I know that this one that it looks like they have a lower upside, its upside is growing 15% a year.
Yeah, exactly. That's the whole reason why I prefer, let's say, a rate of return, because for me it's easier in my mind to compare to other things. Obviously, you can just calculate the upside. That's obvious, but yeah, it's just a framework I use. So I was curious to know the reason behind your yeah, the way you look at
Yeah,
valuation and stuff like that.
it's always
So
better to have both sides of the equation, right? To have really
yeah,
discounted assets that are really good quality and grows.
yeah, exactly. That's the holy grail,
Yeah,
right?
you should pay a premium for that. But if you can have it at a discount, that's even better.
Obviously. That's really cool. So I don't know how much time left you have, but I would like to
All
ask
right.
you a last couple of
Okay.
questions, if you're okay. So the first one is actually, how do you deal with emotions, generally speaking, say in your personal life, but also when it comes to investments? Because I feel like this is a really underrated topic, and people focus more on the technical side of investing, the accounting and all those other things. But what really makes the difference, I think, is the emotional side, and what strategies you employed. Yeah, why don't you guide us through how you think about that?
I usually tend to sleep on it. Whenever I'm too excited or too angry about the results or what the management did, uh, I try to not make any decisions when I'm in this emotional state. I try to just sleep on it and, oh, I can do that tomorrow. The way that I structure the portfolio is that if anything, except for really extraordinary things happening, if anything else happens, I don't have to make any decisions right now. I don't have to be fast. Hell, I usually don't have the liquidity for that anyway. So, and once you start to analyze more calmly what happened, you may lose some opportunity to both put more money at an opportunity or to take it something out because the risk increase or whatever. But I would say that on average, for me, it's best to behave like that. To not make any decisions when you are
Right.
emotionally unstable.
I would tend to agree. I think the potential upside, it's not worth it when compared to the potential downside of making an irrational decision when you're emotional, or the facts are way too fresh for you to analyze them with a rational perspective. So yeah, definitely that's a point to keep in mind, and I try to use that in my own strategy. So for example, when I analyze companies, I try not to look at the stock price when I'm researching, because I immediately know that if I look at the stock price and it increases, I get a sense of urgency to kind of act. So yeah, sometimes that results in the price between the time I started researching and the time I actually bought or didn't bought, changing by 10% or something. But I'm okay with that. If the investment is sound enough over time, that would be relevant.
Yeah.
So
But it's a good
that's
in that sense. It's good. I wouldn't say that it's a strategy or anything like that, but it's good to have most of my positions listed in Asia and my main brokers
okay.
in the US time zone. So I cannot really trade when the stocks are trading.
Right.
I usually trade overnight and put a limit on price.
Yeah, that's exactly what I do. I actually modeled Monispa,
Mhm.
right? So I never trading hours. So only after the markets are closed, because yeah, if I make something impulsively or out of emotion, I can just cancel and yeah, let it simmer a bit more and then actually act upon that information or whatever.
Makes perfect sense. Yeah.
So yeah, I really like the way you framed it. And my last question is a bit more on your positions. I don't know if you want to talk about them, but I saw you basically hold a lot of different but similar cases, investment cases, where basically a holding company owns a strong underlying asset, and then you get the rest for free, or basically it's a big discount. And my question is, in these holding companies, sometimes they trade at a consistent discount to intrinsic value over long periods of time, and that's for a reason, because obviously it's not 100% the asset you're appraising, or let's say the good asset is not 100% of the company, and it's harder to value such companies, so the market tends to punish them with that discount. So why do you think your positions are different in the sense that they will have the unlock of intrinsic value that you want to see in your investments?
Oh, I don't think they will unlock the whole intrinsic value at all. I just think that the discount is way too high. And while
Mhm.
I wait for the discount to shrink, the intrinsic value keeps growing.
Right.
So if most of the conglomerates or the holding companies that I have traded at 30 or even 50% discount to their intrinsic value, I would sell the positions. I know that the intrinsic value it's much higher than the let's say 50% priced in the stock price, but I do recognize that they won't unless they really distribute the assets uh, either by cash or by stock. I recognize that they won't unlock the whole value. I just think that the
Right.
discount is too much. Uh, for example,
Okay.
if I
So
look at Tianjin
yeah, it's a
Development,
matter
it's
of
traded at maybe
too good
80% discount.
to
If
last
it
long,
goes from
basically.
80% discount to huh?
No, sorry, go on.
If it goes from 80 to 60% discount, it's a double. And while I wait, the intrinsic value keeps growing. So that's it. I was saying that I don't think that you will unlock the whole value at all. I think they will keep trading at some discount. The thing is that the discount that they have right now, it's just too much. For example, Tianjin Development is trading at maybe 80% discount of their intrinsic value. So if from 80% it trades at 60% discount, for example, it's a double. And while I wait for
Right.
that, the intrinsic value keeps growing. When I say intrinsic value of any company, it can be a bank or it can be a conglomerate. That's not my target price. That's just intrinsic value.
Okay.
To recognize that it's a target price, I have to look at other opportunities available, not only to increase the positions that I already have, but in the other positions, in the other companies that I have no position at all. So that's my that's my opportunity cost. That's what I look at.
Okay. That's
I
interesting.
don't mind a
So
trading at a discount for a very long time. I might day trading at 80% discount or a 70% discount.
Right, right, right. So you don't mind, you don't have to unlock the full value for
No,
you to get a really good return.
exactly. No.
That's interesting. That's interesting. So last question, and actually, I don't know if the viewer will notice this, but we are having some problems with the internet connection, and that's because you're living in a very rural area in Portugal, which would compare to Omaha, maybe even more isolated. I'm sure more isolated than Omaha, but why don't you talk about how is it living there and how that helps you in your investment process and tuning out the noise and stuff like that?
Yeah, yeah, I'd say, well, just to explain, I live in a city that has maybe 5,000 people as a whole. Uh,
Right.
it's 200 kilometers south of Lisbon, so it's pretty far from the capital. And even the connection really here is not that good. I'm doing all this through 5G because I don't have fiber at home or anything like that. Hell, I don't have water here. I have to, to make a borehole. But
Wow.
yeah, but in that sense, it's very isolated. I can really think uh, calmly about everything that I'm doing. But on the other hand, I don't have the network and the easiness to connect to other investors or even the companies as I would have if I were in New York or in London or anything like that. Uh, so it works both ways. For my strategy, having long-term positions in companies that are not in New York or London anyway. So, and most of the financial industry is not even looking at them. It works perfectly well. And if I have to visit them, um, I just travel. I will do that maybe a couple of times a year. I don't have to do more than that. To visit my investors, most of them are based in Brazil. So I usually do an on-site event in December in Brazil. I take the time to visit my family during Christmas, so it's easier. But that's one travel a year. That's
Right.
how I work.
That's pretty cool. Actually, I would like to experience that for some time, just because even though the city I live in is not too big and it's pretty, let's say, tuned out from the noise, I
It is,
really
yeah.
enjoy the vibe of isolation and stuff like that. But I also really enjoy connecting and talking with people. So just I promise this is the last question. How do you deal with the fact that investing is a single player game and you don't really, let's say, inherently get too much connection with other people? So how you deal with that? Do you let's say engage in sports or other activities that allow you to talk with others, or you are just okay and fine with the being with your family on your own and stuff like that?
I'm usually fine with being myself with the family, but at some point I miss the community vibe. And when I miss that, I usually just travel to Lisbon. I have a few friends there, so it's easier. Or I travel to some other place. For example, a couple of weeks ago, I was in Africa diving with a friend that came from Brazil. Uh, I tend to do this kind of stuff, or I travel to another capitals in Europe. Traveling around Europe is very easy, right? So, and you have a completely different culture within a few hours of traveling by plane. It's not like in the US or in Brazil where you can travel for hours and hours and hours. And okay, you reach a different city, but it's kind of the same environment and the same culture. In Europe, it's completely different if you are in Paris or if you are in Paris or if you are in Budapest. So yeah, I tend to travel. That's my answer for it.
Okay, that's pretty cool. I hope the software recorded that part because I stopped listening to you. But yeah, I think this will be definitely a unique podcast interview. There's nothing like that out there. So thank you so much for coming and accepting the invitation. And it was really, really interesting. I hope the viewers enjoyed as much as I did. So yeah, thank you so much.
Oh, thank you for the opportunity. It was great talking to you. I had a great time as well. I hope to repeat that sometime.
For sure, for sure. You must come back at some point when you have more experiences to share and more interesting and unique companies to talk about. Yeah,
We
for
will
sure.
definitely.
Thank you.
Okay. Thank you so much.